All right, welcome to The Explainer. Today, we are cracking open a really detailed investment note on one of the biggest companies on the planet, Alphabet. You know, the parent company of Google.
Okay, so right out of the gate, this new analysis drops a huge score on Alphabet, 82.5 out of 100. I mean, that's a really strong signal to start with.
And the bottom line that comes with a score like that? The verdict is accumulate. So what does that actually mean? Let's get into it.
Look, a high score and a bullish verdict, that's just the headline, right? To really get what's going on here, we have to pull back the curtain and see how the analysts actually came to that conclusion. What's driving the optimism? And maybe even more important, what are the big risks they're keeping an eye on?
Okay, so first things first, let's get a handle on what we're actually looking at. You can't understand the investment case without understanding the company as it is today. And let me tell you, Alphabet is way more than just a search bar. We're talking about a massive tech empire with a few different engines firing on all cylinders.
And this revenue breakdown really tells the story. You can see right here that, Google Search is still the king. No surprise there. It's over half the entire company's revenue. But look at this slice, Google Cloud. It's now a major player, pulling in over 14% of the cash. And get this, it's growing at an incredible speed.
The scale we're talking about here is just mind-blowing. Fiscal year 2025 was a huge one for them. They smashed right past the $400 billion revenue mark for the very first time. And all the while, that cloud business we just talked about, it grew by an explosive 36% in just 1 year. Think about that. That's a gargantuan business moving with the speed of a startup. It's wild.
So, okay, now that we've got the lay of the land, what's the core argument for being so bullish? Why the optimism? Well, the report really boils it all down to two massive, game-changing trends: AI and the cloud.
So the bull case, it really rests on these three super strong pillars. Pillar number one, their full stack dominance in AI. I mean, they control the whole shebang, from the data to the models, all the way down to the chips. Second, Google Cloud is hitting this huge turning point. It's not just growing like crazy, it's also becoming really profitable. And third, the company is basically a financial fortress. They're sitting on a mountain of cash.
And if you want a number that just perfectly captures that momentum, here it is, $240 billion. 240 times billion. That's the size of Google Cloud's backlog. Now what that is future revenue they've already signed contracts for. And that number doubled in just 1 year. That gives them this unbelievable window into their own future growth.
And it's not just about size. They're also incredibly smart with their money. Check this out. The analysis found the return on incremental invested capital is almost 74%. Okay, that sounds complicated, but here's what it means in plain English. For every single new dollar they put into the business, they're getting back about 74 cents in new profit. That is just exceptional efficiency.
But, it can't all be good news. A good analysis always plays devil's advocate, right? It has to kick the tires. And this report points to two pretty big risks. Clouds on the horizon, if you will, that could mess up this otherwise rosy picture.
Okay, so risk number one is something the report calls the CapEx black hole. CapEx, or capital expenditures, that's just the money they spend on the big stuff, like data centers and all the computer hardware. And that spending, it's projected to nearly double in 2026 to build out all their AI stuff. That is a gigantic pile of cash going out the door, and it's going to put a serious squeeze on their free cash flow, which is the actual profit they have left after paying for everything. The second risk, this one's a little more fundamental. You could even say it's existential. The question is, could this new AI wave actually disrupt Google's main moneymaker? Think about it. Their whole search business is built on you and me clicking on links, which then shows us ads. But what happens if these new AI models can just spit out the perfect answer directly, no click necessary? That's the big, scary question at the heart of the whole bear case. So, let's recap. You've got this insane spending spree on one side, and this potential threat to their crown jewels on the other. So how in the world does the report look at all that and still land on a positive accumulate rating? It's a good question.
And this, right here, is where the analysis gets really critical. See, it's not enough to just make a list of pros and cons. It's about putting them on a scale and seeing which way it tips. Which side has the stronger, more compelling argument?
And the report actually models this out. In the worst case, or bear scenario, they see the stock falling maybe 24%. But in the bull case, the best case, it could jump by 36%. So when your potential gain is bigger than your potential loss, you've got what investors call a favorable risk-reward setup, and that's exactly the kind of thing they're hunting for.
And then there's this other little thing, what the report calls the Buffett signal.
In late 2025, Warren Buffett's company Berkshire Hathaway went out and bought a brand new multi-billion-dollar stake in Alphabet. When arguably the most famous investor in the world does that, people notice. It's seen as this huge stamp of approval on the company's quality and long-term value.
So here's the bottom line. The report basically says, yes, the risks are absolutely real, but Alphabet's strengths are just stronger. The analysts are betting that AI ends up being a net positive for them, that the huge cloud backlog acts as a kind of safety net, and now that some big legal issues are behind them, the road ahead just looks a lot clearer.
And that's our breakdown of this investment note on Alphabet. And before we wrap up, I have to give you the standard but very important disclaimer. I am not a financial advisor. The content in this explainer is strictly for educational and entertainment purposes. It is not financial, investment, tax, or legal advice. Investing in the U.S. stock market comes with significant risk, and that includes the potential loss of your principal. And remember, what happened in the past is no guarantee of future results. So please always do your own homework or talk to a certified financial professional before making any investment decisions. We'd love to hear from you, so please tell us which U.S. stock you'd like us to feature in the next research note. And hey, don't forget to subscribe and hit that bell icon for real-time updates.